Q3FY23 conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Purohit from PhillipCapital. Thank you, and over to you, sir.
Thank you. Good afternoon. On behalf of PhillipCapital, I welcome you all to the AllCargo Logistics 3Q FY23 earnings call. From the management, we have with us Mr. Ravi Jhakar, Group Chief Strategy Officer, and Mr. Deepal Shah, Group CFO. Now, without much delay, I now hand over the call to Mr. Ravi for his opening remarks, followed by Q&A. Over to you, sir.
Yeah, thank you very much. I welcome you all to this conference call. And this is Ravi Jhakar here. I'm joined by my colleague, Mr. Deepal Shah. Let me first take this opportunity to highlight that we have received the order has been pronounced by the NCLT on the demerger and it has been uploaded on their website. Because of that, while the process is still underway and we estimate that the companies should eventually get listed in around April, we had to report the results in a slightly different format, highlighting the continuing businesses, discontinuing businesses, and so on. Therefore, let me first specify that post demerger being completed, we would be having 3 listed entities. And since it is a mirror demerger, for each share of AllCargo, the shareholders will continue to hold 1 share of AllCargo and would get an incremental 1 share each of AllCargo Terminals and TransIndia Realty. As we will get to see the results in the coming quarters on a consolidated basis, the results shown here under as continuing business do not include the numbers for the container freight station and the ICD business, which should be parked under the AllCargo Terminal. It does not include the numbers for equipment and the logistics parks business, which should be under the TransIndia Realty. And it also does not include the contract logistics numbers, which in the coming quarters will see consolidation with the AllCargo Logistics. So therefore, the 237 crores EBITDA, including other income, which is being seen, only represents a part of what would be the consolidated numbers for the main listed entity, apart from the 2 new demerged entities. And therefore, the right approach to look at the financials for this quarter would be to look at the combined performance, combining all the businesses. And we would provide that clarity in the investor presentation, which we shall be uploading later today. The idea also is to get all the questions, considering that there has been a change in format and there could be different perspectives, questions and clarifications which our shareholders and analysts and investors might have. So we'll be happy to hear all the questions and to ensure that everybody benefits from the answers and the clarity provided by the company. We would incorporate the information which we deem important and adequate in the investor presentation to be uploaded later today, which will provide clarity on any points that might be there. So this is a brief note on the most recent activity on the demerger and the short-term view on how the results have been presented. Now coming to a more long-term strategic importance, which is around how the business has been performing, I am glad to state that our flagship business of LCL consolidation, which is contributes to almost 70% of gross profit in the international supply chain business, has continued to see market share expansion. And for the first time, we have now crossed 15% global market share in LCL as we speak today. However, in the quarter gone by, there were disruptions in China which have brought the overall market itself down, and therefore they do not reflect in the growth in the numbers. And if you look at year on year, the numbers are flat. But one needs to note that market share expansion means that while the industry and the competitor volumes went down for the corresponding period, we maintained them on a year-on-year basis and degrew at a lower pace. We are already witnessing that post-Chinese New Year, China has started to normalize on the supply chain side. Factories are back in operation. And therefore, for the part of this quarter, which is February and March, we would see normal activity. And from April onwards, on a quarterly basis, we should see normalized production and supply chain activities from China, truly reflecting this market share expansion that we have achieved over the last few quarters. Another important event which has happened recently is the consummation of Blackstone transaction, which has been pending for reasons beyond our control for a long period of time, and almost on every quarterly call we've been discussing about that. I'm glad to state that that is now being consummated. The SPA has already been signed, and therefore, while on the 31st December, you would notice that the consolidated net debt is already down to only 130 crores. Post 31st December, with the Blackstone transaction being consummated, approximately 295 crores of debt has been alienated from AllCargo books, and the company has also received additional cash inflow of about 135 crores. So instead of holding a net debt, we would rather be cash positive. And even if we take into account the outlays for acquisitions recently announced, we estimate that even despite taking into account the investments required for the same, as we close the financial year FY22-23, we would still be cash positive or near zero net debt. So that's been a big development from the balance sheet perspective. And this means that we would be able to acquire the 30% stake in KW in the operating express entity. I'm also pleased to announce that we have been looking at focusing on contract logistics, and therefore there was a demerger which was underway, and we have also received the NCLT order very recently, and we would be completing the process for the demerger for that business as well over the coming weeks, and therefore that business would also get demerged into ASCPL, which as on date is 100% custody of AllCargo Logistics. What does not contribute to the numbers in the quarter gone by, but would provide further growth opportunities are some of the acquisitions. A strategic acquisition that we did in Germany, which would be effective from an accounting standpoint from 1st of January, and a small bolt-on acquisition in Turkey to add to our strategic capabilities in Turkey. So all these initiatives would continue to drive growth for the company. On the digitization front, we continue to maintain healthy export bookings on platform, which are over 63% of the total bookings, and that is an industry-leading number, far ahead of the competitors operating in the similar business segment. We have been able to work further on automation, data science-based network optimization, and other initiatives which are allowing us to become more lean and efficient as we grow in the existing businesses further. What we have done beyond that is we are also looking at launching new products and new trade lanes, and therefore we continue to invest in building new products, bringing on new people, and building new trade lanes. We are looking at significant growth in the air freight business, which forms a small part of the business, and therefore would, on an overall basis, may not have a very significant impact. But over the coming years, we believe that without any significant capex investment, on the back of our global network, global relationships, and synergies with the ocean freight consolidation, you will be able to do some amount of asset-light, digital platform-backed air freight consolidation business as well. On the trade lanes, we already operate about more than 2,400 direct trade lanes globally, which is by far the highest for any LCL operator or any other carriers globally. We continue to see opportunities on the back of our scale and on the back of technology tools which are now available to predict routes. We are able to launch new trade lanes, and we anticipate that now we are in a position to add almost 100 trade lanes on an annual basis, which means that we would open up new avenues for growth In the short term, it also means that as we open up a new trade lane, the utilization levels pick up over a period of time, and therefore there could be some marginal investment. But we estimate that on these trade lanes, any new trade lanes opened should be able to neutralize the impact within a 3 to 6 month window and start making positive contributions thereafter. So from a long-term growth perspective, on the main international supply chain business, we see continued opportunities for growth and also improving the efficiencies on the back of digitization. On the FCL business, given the macroeconomic slowdown, we have seen a flattening of volumes, and as the market picks back, because currently this is against the backdrop of falling volumes on the trade lanes that we operate in. As the volumes start picking up, as I mentioned, which we are already seeing from February onwards, we estimate that we should be also able to start back on the growth journey on the volumes in FCL business. From a freight rate perspective, we have already seen that freight rates have come back to the near pre-COVID levels, and that normalization in freight rate has impacted the FCL business profitability. As we have been stating in the earlier calls as well, LCL profitability is largely a factor of container utilization, which continues to remain that way. And on the FCL, we estimated about 15 to 20% drop in utilization on a per TEU basis. And considering the historic average of 20% growth rate, the numbers when you multiply, it remains consistent. So while the normalization of freight rates has happened, the market being subdued, the growth hasn't come through in this quarter. We estimate that with rates, with the trade routes normalizing from February, the March onwards on a monthly basis and April onwards on a quarterly basis, we should see the growth in volumes back in the FCL business, recouping the lost gross profit on the FCL business. So on an overall basis, if you look at the combined EBITDA, we are looking at a number of about 340-350 crores, which is of course lower than the previous quarter, but is broadly in line with the business projections based on the macroeconomic environment. And we see the performance, as I mentioned, to pick up starting from mid-Feb onwards and should start reflecting partially for the month of March and fully from the quarter starting April onwards. The other key part is that we have been focusing on the asset-light digitally enabled businesses, and that is something which continues to work well for us. And even in the contract logistics business, we have seen continued opportunities for growth, and the growth momentum continues. On the container freight station business, we have been noticing a recent uptick in the EXIM cargo of the country, and we are a direct beneficiary of that, wherein we see the growth in business increasing in line with the increased EXIM cargo growth in the country. So on an overall basis, we see this as a quarter which has had negative impact on account of macroeconomic environment. But from a long-term perspective, we see this also as a quarter where we demonstrated resilience in our performance, gaining market share, and achieving conclusion to several strategic initiatives, including the Blackstone transaction and the demerger, which would pave way for a robust growth in the years to follow. On that note, I invite my colleague Deepal to throw light on some of the financial highlights for various businesses. Over to you, Deepal. Thank you.
Thank you, Ravi. So, Ravi, like you mentioned, that the results now include discontinuing operations in light of the demerger order. So these have to be combined, continuing to have a comparative clarity from the previous quarters. So I'll walk you through the financial performance. For the 9 months of 2023, AllCargo Logistics Limited consolidated revenue, including the discontinuing operations for comparative purposes, stands at 15,301 crores as against 14,296 crores for the previous year, registering a 7% growth year-on-year. Revenue from continuing operations stood at 4,099 crores in Q3FY23 as against 5,599 in Q3FY22. Revenue from combined businesses, which includes the continuing businesses, discontinuing businesses, and contract logistics, stood at 4,473 crores for FY23 Q3. EBITDA from the continuing operations stood at 229 crores for Q3 FY23 and against rupees 434 crores during the same period last year. EBITDA from combined business stood at about 343 crores in Q3 FY23. For Q3 FY23, the company reported a PAT from the continuing operations of 124 crores as against the 24 crores for the same period last year. Now moving to the segmental performance for the quarter. I'll start by discussing the performance of the main segment, that is the international supply chain segment, which is the largest segment, which operates under the umbrella of PQ Worldwide. The segment reported in Q3 FY23 a revenue of 3,671 crores as compared to 5,200 from the same quarter last year. Revenue for the 9 months stood at 13,300 crores, approximately 0.5% growth over the last year. EBITDA for Q3 stood at 274 crores as against 430 crores for Q3 FY22. Analysts ROCE, which is the most important tracking segment parameter that we look at, stood at 53% for the international supply chain business. Moving on to the express business operating under the brand Gati. It has continued to deliver solid performance during the quarter. The company is undergoing turnaround and continues to scale up operations under experienced leadership and infrastructure amplification. The sales acceleration programs have been reaping benefits leading to increased volumes handled during the quarter. Express business revenue for Q3 FY2023 stood at 379 crores as against 352 crores, up 7.5% YOY basis. The EBITDA for Q3 stood at 21 crores against the last year, which was 16 crores, a growth of 31%. With better yield management and operational capabilities, we believe the business is progressing well and will achieve the desired goal. Contract logistics revenue for the quarter stood at almost 100 crores and EBITDA stood at 31 crores. Coming to the CFS and ITV segment, we are poised to deliver growth through enhanced customer experience with MyCFS initiative and better import-export mix. The business reported a revenue of 175 crores for Q3 23 as compared to 177 for the previous year. Speaking about equipment hiring segment, we've been continuously working towards moving to an asset-light approach by providing quality services to customers through a combination of owned and leased assets. The equipment utilization stood at 80% as a capacity utilization. We have been consistently providing other key parameters and financial performance indicators in our investor presentation. One can refer that for more details as we upload towards the end of the day. With this, I would like to open the floor for questions and answers. Thank you.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question on the line of Chetan Shah from Abacus AMC. Please go ahead.
Yeah, hi. Thank you for a detailed thing. Just wanted one small data point. Can you give me what is MTO's TEU equivalent, both LCL and FCL combined, which was roughly 2.48 lakh in the previous quarter? What would be this number for this quarter?
So on the volume side, like I mentioned, the performance for this quarter is flat as compared to the same quarter previous year. As compared to the previous quarter ending September, the FCL volumes are down about 2 to 3%, while the LCL volumes are down about 6 to 8%. And we will have the exact numbers shared in the investor presentation that will follow.
No problem. And just one question, or rather, let me put it this way, one small clarification. You spoke that the combined EBITDA of about 340-350 crore, are you referring to a quarterly numbers going forward for a MTO business or a company as a whole? I got a little confused with that. I'm sorry
Yeah.
for this.
So let me clarify. I was referring to the numbers for the quarter which is concluded on 31st December. So this is not the forward quarter, but the quarter which is got concluded.
Okay. Yeah, got it.
To add the various businesses because currently they are clubbed into three pockets: continuing businesses, discontinuing businesses, and the contract logistics, which is sitting in none of the two buckets. So if you want to take a view of the future view, which is the three listed companies, but look at the actual performance of December 31, 22, that is what it would look like.
Okay. Thank you so much. Thank you.
Pleasure.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question on the line of Deep Master from One Up Financial. Please go ahead.
Yeah. Hi, Ravi and Deepal. And firstly, congratulations on getting the demerger through. So just a small request from me, if we could get the investor presentation in advance of the call, that would really help us prepare, for the call. So I understand that this time you all wanted some, suggestions and, suggestions from us. But, even if you had stuck to the previous format, would have helped us prepare, for the call. And so one question as well from me on the volume side, like you mentioned, the volumes are slightly lower. And on the profitability though, on the LCL side, is that broadly maintained quarter on quarter?
So the gross profit percentage margin would appear to be higher, but that is only because the revenue has come down. The way to look at this business would be that you would see that the revenue has come down by approximately 970 odd crores, corresponding to which the operating expenses have come down by 900 crores. So that gap of 80 crores is what the impact is, which is again can be bifurcated into two parts. One is the actual loss in margin on the FCL business, which we've been stating that when the freight rates normalize, which is what they have normalized now, would be in the range of 15-20%, which is one aspect. And the second impact is on account of growth initiatives, investments into new trade lanes, etc. There is a way to look at that number. So when you look at percentage terms, obviously gross profit as a percentage might appear to be higher because the revenue base becomes lower. So the right way would be to look at the gross profit number in absolute terms and how it grows over time.
So put another way, the gross profit on a per TU basis, if we adjust for FCL, so if we look at only LCL, would that broadly be maintained quarter on quarter?
So gross profit on LCL basis broadly would be maintained. There would be a marginal decline on a gross profit per CBM, but that would be almost flattish. Like I said, only few new trade lanes that have been launched, which should be on low utilization. Those would impact it slightly, but otherwise the utilization is the only parameter which impacts the profitability on the LCL. So new trade lanes plus the marginal decline in the volume. Those are the two factors which impact. So as the volumes have started to rebound, the profitability for LCL would be similar as it was in the past, assuming the freight rates continue to remain same. They don't go up or go down. That does not make a difference. FCL business, the profitability depends on the freight rate. So now the correction in freight rates, that has come down on a per TU basis by 15-20%, which was what we had estimated earlier.
Yeah, which you've been also, mentioning for the last few quarters. So appreciate that. It's just that, we didn't have the volume, so just wanted to confirm. Secondly, on the...
we thought that maybe we get more questions and perspectives and try to answer all of them with the right data points, because the format that we had to upload the numbers in and the format in which it could be most clear to all our shareholders, investors, and analysts. That's why we took a call that maybe we'll upload the presentation later during the day. But your point is well noted.
No, thanks for that. And so, just if you could get some more color on the volume. So like you mentioned that there have been some disruptions, so are there any particular trade lanes you can point out to that would have been much weaker in the quarter gone by?
Yeah, so primarily from the month of November, about, November, maybe expiring in November first week. So from November second week onwards, particularly, the 8th and November, till end of January, primarily all trade lanes originating out of China had a significant impact. And likewise, so whether it was, trans-Pacific trade moving from China to Americas or even China to Europe trade, those were the key trade lanes which were impacted. Apart from that, there were a few other trade lanes also, particularly ending in the UK, because UK has exceptionally seen reduced trade activity as well. So these are the two countries which will stand out in terms of the overall market being down. from company's perspective, we saw disproportionate growth in select markets where we've been running the sales acceleration program. So countries like United States, Vietnam, a few select countries in like Indian subcontinent, Turkey, and a few select markets in Europe. That's where we saw disproportionate growth, and that is what led to market share expansion. So there will be many countries, if you break down, wherein we may be up 5% while the market may be down 20%. So some of those robust performances is what contained our decline to, like I said, about 6-7% on the LCL on a quarter-on-quarter basis and 0% on an year-on-year basis.
Understood. That's very helpful. And do you think that there was a general trend of sort of destocking that's been happening in many commodity-related sectors? Is that also impacting some of your clients?
So what we understand is that, prior to Christmas, the demand anticipation was weaker, and therefore through August and September, or rather through end July to early September, the orders were fewer, and which meant that the shipments, which typically follow 45-60 days later, were not how we typically see a December ending quarter, which usually is the highest. There's a lot of orders flowing before the Christmas. However, the actual sales for many commodities seem to be much better than anticipation, and therefore the inventory levels fell short. I mean, the most commonly heard example is say on the Apple products, because that's one product which gets tagged and therefore any information is available, wherein the issues were more on the supply chain side, wherein demand was there but the products were not on the shelves. On the general mass consumer products, we believe that the inventory levels were sufficient. Like, if we talk about, products like detergents or, tissue papers or those kind of household goods, our understanding from the market and also looking at the underlying trends is that those seem to be reasonably managed from the stocks that were there. But we anticipate that now post-Chinese New Year, the inventory levels are depleted and therefore the inventory restocking would happen. And which is where we anticipate that from March onwards, the trade should see a pickup on the back of inventory replenishment. And somewhere towards the second half of the year, we should see more robust growth, taking into account that there are no further unforeseen events of like global catastrophes or wars, etc. That is the broad macroeconomic view that we hear and sense from the underlying data that we have.
Sure, perfect. And if I could just squeeze in one more, just one related to your acquisition in Turkey, if you could, maybe just spell out your vision and, how that could, be additive to your overall LCL and FCL in that region.
So that is, to be honest, one of the smallest acquisitions we have done. That's just a strategic acquisition which allowed us to get the right set of people and some, specific trade lanes that we could get stronger on in that geography. And that has allowed us in that particular market, though it's a small market for us right now, we were able to increase our volumes to nearly by 70-80% on the back of this acquisition. And now with the combined capabilities, we can grow well. But from an overall perspective, this is not something which would make a significant impact. We believe that the German acquisition, considering the importance of the German market in the global network, would perhaps be more impactful in the coming quarters.
Perfect. Thanks a lot, Ravi.
Thanks.
Thank you. We have the next question on the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question was in terms of the EBITDA number that you mentioned, 350 crores for this quarter. So could you give me a breakup of this EBITDA? How did you arrive this number?
Yeah, so if you look at the breakup on the continuing business results which have been shown, it is approximately, if you add back the interest and depreciation to PBT, you could see that it totals to about 237. Excluding other income, that is about 229 crores. Approximately 31 crores would be the contract logistics, and approximately 81 crores would be the other discontinued businesses. Put together would be about 343 excluding other income and 351 including other income. That's a broad range. And we will share these numbers in the format so that it's easy to understand in the investor presentation as well.
So there is one item called unallocable and other items. So if given the quarterly result that you have released, so we can get the EBIT number from that. So in that there is this minus 63 crores EBIT for this unallocable. So will this be a part of continuing operations or will this be demerged?
No, so this will get allocated once the demerger is done. So it's unallocated at the moment, and we are working on the allocation. So at the point of demerger, this will, in the respective right proportion, will get allocated to the individual businesses.
Okay, sir. And also, continuing with the same point, in the press release it is mentioned that some corporate costs have not been allocated to discontinuing operations.
That's
so is it correct?
That's the same thing. That's the unallocable. That's the same that we're discussing.
Yes. So is it correct to understand then that some part of the employee costs and other expenses are still yet to be removed from the numbers that you have reported this quarter, and subsequently or in subsequent quarters some part of it will get removed?
Yeah, so please understand that we've been operating these segments as SBUs, and there is a corporate cost also there. So as far as the corporate costs are concerned, which we have very clearly mentioned in our results, these need to be allocated, and these will be allocated at the point of demerger.
So, do you, I don't know if you have, but will you have any kind of ballpark number as in how much is expected to get?
No, that segregation is still underway, so we don't have any ballpark numbers at the moment to share.
Okay, so on a YOY basis, actually, despite flat MTO volumes, we have seen that the employee costs and other expenses have gone up. So, if we remove these corporate expenses that are supposed to be removed later on, so how would these employee and other expenses look like?
Sorry, if you're referring to the employee and other expenses, primarily on the employee expenses side, like I referred to in the earlier commentary, we have been investing in people and new teams and new product launches. So to that extent, those costs will be there. And I'm not sure of what exactly you mean by removing the corporate costs. Could you just restate your question, please?
So actually, there is in point number 6 of the notes part in the presentation, there is one statement which states that corporate costs have not been allocated to discontinued operations. So I was wondering whether some of the costs will go to the demerged entity that are currently being shown in other expenses or employee expenses in this quarter.
Okay. So I'll explain once again very clearly that segment reports were as an SBU. Earlier also, if you look at the segment reports which were reported earlier, the corporate costs were not allocated. Segment was without the corporate costs. Now, what we have done is that we have very clearly identified that there is an amount of corporate costs which needs to be allocated. And these corporate costs will get allocated to these continuing and to the discontinuing operation based on certain scientific parameters. And that working will happen at the point of demerger. That is what is underway.
And if I can also just add to that, so while the segmental breakup will be done, but if you look at the, if you move away from the segmental and look at the reported numbers consolidated for the continued business, that basically reflects what would be in the continued business, and the remaining part will be in the discontinued business. And which is what, like I said earlier, we'll also provide revenue to EBITDA sort of a breakup between the continuing business, discontinuing business, and the contract logistics business to provide a combined view. So we'll include that. So hopefully that should be the data point that should help resolve your query as well.
Okay, sir. And is there any one-off in terms of expenses in this quarter?
So there's a marginal around $2.5 million of licensing costs, which is an exception in this quarter. Nothing other than that. So no significant. $1.5 million, so around 8 times 10 crores.
Okay, sir. And just one last question. So currently, freight rates are
one-offs as such, apart from this approximately 9 to 10 crores, some of which I can refer to.
Okay, sir. And sir, just one last question. So, given that if we see the Jan and Feb month, so currently freight rates we can see it is around, like you mentioned, pre-COVID levels of $2,000.
Other questions?
Sorry, sir.
Is the management able to hear us?
Are we audible?
Yes, sir, we can hear you. Are you able to hear us?
Hello?
Ladies and gentlemen, we'll reconnect the management. Appears that they are unable to hear us. Over to you, sir.
Yeah, thank you. It appears that there was a network disruption. So, responding that the clarity on the continuing, discontinuing, and the contract logistics businesses and providing a combined view of the same should hopefully provide clarity to you and address your queries. And I believe that you had a follow-up question which you could not hear. So, if you could please ask it again. Thank you.
Yes, sir. Thank you. So, sir, if you take flat and international supply chain volume numbers for this quarter, then the EBIT per TEU comes sub of 10,000 per TEU. So, how confident are we, given that even in Jan and Feb, there is decline in freight rates by about 15-20%. So, how confident are we of maintaining this EBIT per TEU of 10,000 plus in the subsequent quarters?
Yeah. So on the current levels, like I mentioned, as far as the LCL business is concerned, the freight rate sensitivity is not there, which is only to the extent of utilization. So as the volumes come back, we would see sustenance and further improvements. On the F business, we anticipated 15-20%, and almost the same number is already been, impact has already been seen. So there could be nothing more than 2-3% here or there. Is how we would put across as our estimate on what it could look like from here on.
Okay, thank you. That's it from my side. Thank you for answering the question.
Thank you. We have the next question on the line of Ravi Mehta from Deep Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just on the EBIT per TEU thing, the number looks pretty healthy if we build in whatever volume guidance that you're giving for the quarter. So wanted to know that the freight index has been falling all through the quarter. So the entire fall is captured in the performance, or there is some spillover effect which we can see in Jan Feb of the fall that has happened till December.
So, yeah. So if you look at the fall, and if you look at the continuing business numbers that we have shared, while the revenue has gone down by 979, the operating expenses have also gone by almost 900 crores. So the data is very minimal, and which is basically because the ocean freight rates are largely a pass-through, except for the impact on FCL, which, as I stated earlier, of the amount of 15-20%. So there is a reason why you find that the EBIT per TEU on the EBITDA or EBIT per TEU would largely get maintained and be impacted more by the how the SG&A costs are, how growth initiatives are being undertaken, how volume growth gets driven. Those things will impact these numbers, and they may fluctuate, but we do not anticipate freight rates to have much impact going forward. FCL impact, which was there, like I said, almost the entire part of it is already captured on the revenue side, and therefore is at least to an 85-90% already visible. And on LCL, anyways, like we've been stating, it's dependent upon utilization, not as much on the freight rates.
Okay, so largely everything is captured in FCL for the quarter, given the fall, right?
Yes. And that is why you see a significant drop in the revenue.
Sure.
which is much more than the drop in volumes.
And one point probably I didn't catch it in your opening remarks. Probably you were referring to some demerger of Gati KW into ACCL, or I just missed what probably you highlighted. Like you've received some NCLT order and probably you are.
Yeah. So let me
just highlight on that. Yeah.
So there are two demergers that you are referring to. One is the demerger of AllCargo Logistics, whereby the two business segments would move into AllCargo Terminals in Trans India Realty. For that, the NCLT has pronounced the order and the order has been uploaded on the website. We are awaiting certified copies, post which we will file with ROC and take the process further with exchanges. And by April end, we estimate the new companies will get listed in addition to the continuing businesses under AllCargo Logistics. The second demerger which I referred to was the demerger of ACCI, wherein we had also shared in the past that we intend to focus on contract logistics. And for that demerger, we have already received the certified copy also just recently, like a couple of days back. And we would be now filing that with the ROC and concluding that demerger also. So this contract logistics business would move into ASCPL, which is currently a 100% owned subsidiary. So that is the second demerger, which was the demerger of contract logistics business from ACCI, which was a joint venture that we had. That was the second demerger which I was referring to. On the KW, my comment was that we have already approved buying the 30% stake from our Japanese partners in line with our agreement discussed and agreed at the time of first acquisition in Gati. And I had also added that we are already having sufficient, cash on balance sheet to take care of such investments, keeping the net debt to near zero or cash positive level.
So just one follow-up that. ACCI is a 60 or a 70% holding of AllCargo, right? So it will be moved into a 100% own. You mean to say you will be consolidating your entire holding into it?
So going forward, the contract logistics business, which is being managed by AllCargo, would be consolidated with AllCargo from the coming quarter onwards, while the CCS, which is the custom clearance business, which is also a small part of the ACCI business, which is not strategic for us, that would be managed by our partners and therefore would not be consolidated with AllCargo.
Okay, and this will be 100% consolidated, the contract logistics?
Yeah. Post the demerger and the transaction, this will be 100% consolidation.
Sure. And any incremental investment that we will have to put, because I think we'll be increasing our holding from 60% to 100%.
As we look at increasing the holding further, there would be investments for which we would, take the board approvals and execute them. For the time being, for the purpose of management, there is already agreed that post demerger with the similar holdings as well, the management of contract logistics business would be completely with the AllCargo management team, and therefore the consolidation would happen irrespective of the shareholding increase happening there.
Okay. And for the KWE transaction that is already done, I think the agreement is done. So the amount that you will be giving to the partner and by when?
So we have been discussing on the timeline. The amount is already frozen and has been communicated as well. On the timelines, we are working out what's the most appropriate timeline, which is suitable for both partners. And from a cash flow perspective, like I mentioned, we are already now net cash positive on a control basis. So we can do that transaction in discussion with the partners, and we would perhaps share some updates in the timelines. But the amounts are already frozen at which the transaction will take place.
So can you share the amount if probably for my negligence?
So it was, I don't recall the exact number, it was about 400 to 403 crores around that number.
Sure.
We can, there's a reference to it in our earlier announcement.
Sure. Okay.
Presentations.
Okay. Thank you for answering my questions.
Thanks.
Thank you. We have the next question from the line of Kashyap from Broadview Research. Please go ahead.
Hi, I just missed your volume commentary. You mentioned that the volumes are flat YOY, and on a QOQ basis, it was down 2 to 3% in FCL and 6 to 8% in LCL. Did I hear it correctly?
Yeah. So I would say that, that's exactly what I said, but I would also say that the YOY number is less relevant because the trade environment has been very different. The Q-on-Q numbers are more reflective of the current trend, and there it has largely been led by the Chinese supply chain concerns, which led to significant reduction in market size in China. And while globally also other markets have seen contraction or flat numbers, the overall market has actually shrunk on a quarter-on-quarter basis. Basis our internal estimates of tracking competitors across all key markets, while we have degrown by a lesser percentage as we have expanded the market share.
Sure. But I'm not able to reconcile. This because in Q3 FY22 presentation, the LCL volume reported was 2473,000 CBM, and in Q2 FY23 presentation it was 2374,000 CBM. So essentially, if I take a QOQ drop, then it comes to 2231. So essentially, it points to a 5% degrowth YOY and not flat YOY. So I'm not able to reconcile because either the reported numbers are inconsistent or something I'm missing because this is the way it's showing up.
You can have to compare with the Q3 FY22 numbers, which we are referring to.
Q3 FY22, if I take a 6 to 8% drop, it kind of shows YOY drop of 5% on the overall volume. And not flat YOY.
No, so the numbers from Q2, which is the September ending quarter, the drop would be the numbers which I mentioned about 2 to 3% and 6 to 7%, which would be in line. So if you look at the Q2 FY23, that was about that much above the Q3 FY22 number.
Okay. No, I get you, but when I plug these variables, it shows both lower. It shows on FCL and LCL, it shows lower number YOY. That's all I'm saying.
So anyways, we have the exact numbers calculated as part of the investor presentation. You can refer to the exact numbers, and you can please come back to us if there is any.
And obviously the resultant EBIT per TU, which now, if I kind of do this math and the resultant EBIT per TU, which is in that 9,800 odd range, versus 15,000 that you were in the last few quarters. Just wanted to understand, you mentioned that the overall rates in the LCL is hasn't changed much. You've seen drop in LCL, in FCL. On the LCL, it's not changed much, but it was more a function of utilization. Could you just explain that a bit? I'm a bit new, so if you can just clarify what you mean by this.
Yeah, sure. So, when you get down to the EBIT level, we are looking at the impact of two key components. One is how the operating margins, the gross profit margins vary, and second is how the SG&A costs vary. On the gross profit side, like I was commenting earlier, against the revenue drop of about 979 crores, there's also the approximately OPEX drop of 900 crores. The incremental delta is on account of the FCL and investments into developing new trade lanes. But they typically pay back very quickly in a period of about 3 to 6 months itself. The trade lanes start operating on a neutral and then profitable basis. The second impact which will come in is on the SG&A side, wherein the cost would go up on account of some margin increase, of course, will happen on account of inflation. But there also, as we are expanding into new capabilities, we're building the airspace, we're building new trade lanes, there'll be some investment going in there as well, which typically would lead to growth in business. So these are the two inputs which would impact the EBIT on a per TU basis. Now, as we move forward, the SG&A costs do not grow in the same proportion as volumes. The gross profits would remain pretty much in line on a per TU basis. Therefore, the EBIT per TU number should remain constant or grow from here. That is the broad analysis which one could look at.
Sure. So basically, the realization per TU, which is showing up to be down close to 18-19% QOQ, that doesn't have too much of a bearing on the EBIT. I mean, it's largely the SG&A and the trade lane investment, which is kind of impacting the EBIT number more than the realization drop.
Yeah, there has been an impact on both OPEX. If you look at, like I said, if you look at the OPEX also has, but on a per TU basis, yes, OPEX is almost in line with the degrowth in the volume. On the OPEX per TU basis, there has been a limited impact. The impact is more on the SG&A per TU, which as the volumes pick up should see an improvement.
Okay, Fair enough. Thank you so much. I'll connect with you separately. Thank you.
Yeah, sure. And like I said, we'll provide more information in the investor presentation. Along with all the clarifications based on questions today. So thank you.
Thank you so much. Bye.
Thank you. We have the next question from the line of Sameer Deshpande from Fair Deal. Please go ahead. Sameer Deshpande, can you hear us?
Yes. See, I would like to have clarification that it was mentioned that there is a net debt on the balance sheet as on 31st December of 130 crores. And after 31st December, we have received some money. And then now we have net cash. But again, there will be some outflow. And whether we will again go in debt or we will be having zero debt now.
Yes, thank you. And let me clarify on the numbers and reiterate. So as you rightly pointed out, as of 31st December, we have the consolidated net debt of approximately 188 crores, including all the group companies, against which we have de-alienated the debt to Blackstone as part of the transaction, which is about 200 crores. And we have also received cash. So total about 400 crores impact has been positive. And therefore, there will be net cash of over 200 to 250 crores on the books on a net consolidated basis. Now, in terms of the business outlay, there is one which is towards the KW acquisition, which is already laid out, approximately about 400 crores, which is there. And from a capex perspective, the business is asset light and does not have much of a capex. And there will be internal accruals which will continue to accrue for the coming months as well. So even if we take into account the investments into buying out the shareholding from KWE, as of 31st March FY23, we anticipate that the net debt will still remain at near zero levels because the current surplus from the cash plus the internal accruals will largely take care of the investments required.
So we'll be having a roughly zero debt as on 31st March 23.
That is right.
After that investment for KW. Okay.
Yes.
And
like I said, today we are cash positive on 200 to 250 crores, more internal accruals to follow.
Yes.
Which will be good enough to take care of the 400 crores investment required for buying the stake from KWE.
Okay. And now regarding this clarity about the demerger and everything, we will be getting the shareholders of AllCargo Logistics currently holding will be getting one share of both these companies which will be demerged.
Yes, it is an absolutely classical mirror demerger. For each one share of AllCargo, the shareholders would continue to hold that one share of AllCargo Logistics and get one share each of TransIndia Realty and AllCargo Terminals as the demerger process gets completed, which we had earlier estimated it will happen sometime between March to May, and we've been maintaining the timeline, and we're glad that it will be happening in the same timeline. And we expect now it will be happening sometime in April.
So the current shareholder will be having shareholding in three different companies in April or May, whenever you complete that.
Share of AllCargo, you get one more share of AllCargo Terminals Limited and one share of TransIndia Realty. So you'll have three shares instead of one share.
Yes. And now this, when you mentioned that the operating profit, that is EBITDA, excluding other income, will be 343 crores. So when I compare it with your earlier figures reported before this reclassification, which you have done now in restated figures in this quarter, actually the operating profit 343 crores compares with the 505 crores of the Q3 last year. Is it correct?
Yeah, so last year Q3 was an exceptional quarter, and we had also provided guidance that this is a one-off quarter on the back of exceptional trade rates and trade flows, and we had provided guidance that was not a sustainable number. And if you look at the subsequent quarter, which has been between 400 to 450 crores, that has been the more steady, performance. This quarter has been on the exception on the lower side because of the China supply chain issues. So that is how I will put it across.
But now from February onwards, that is maybe half of this quarter, current quarter, was affected, almost 30 days or 40 days, were affected by the Chinese lockdown. But now, after that, it has opened up. So this current coming month and March, we will be seeing good growth?
Yes. So for the quarter, for the month onwards, from a monthly perspective, March onwards, we are anticipating improved performance. From a quarter perspective, like I said, the lockdown and the disruption started around November, so there were about 2 months in the last quarter. This quarter will be more like 1.5 months, so marginally better. But then February is also a shorter month, and so therefore it will be pretty much in line with the current quarter. But since it starts improving from March onwards, April onwards, the performance should get back in line with the quarters that we've been seeing and grow from there on the back of the volume expansion. Because the market share expansion is already happening. As the market recovers, the volumes will start to bounce back as well. And we have also shared guidance from a long-term perspective for 2026, which I would like to reiterate that we will maintain that guidance, and we should be sharing again in the investor presentation.
Okay. So let us hope you are in a position to upload your latest presentation as early as possible. So because these things, you people are adept in all those things, but to understand these things becomes difficult unless it is properly presented. So hope you upload it as early as possible.
Absolutely, we shall, and the idea is also to ensure that we provide all clarifications and because this is a very unique quarter with discontinuing, demerging operations. Therefore, we wanted to be sure that we provide everything that is required in the presentation so that all the shareholders and analysts and investors can get comprehensive perspective on all things that matter.
Yes, because today, if we see the reaction in the stock market also, our share was down 20% for some time. And then later, when I think there was an interview on ET Now, and some clarification was issued that the operating profit is around 350 crores odd, as against 229 crores. Then the share has recovered a bit. So that is the thing. When these type of things, extraordinary events are there, as someone mentioned earlier also, it will be better if we give the presentation. And then later you can again have some suggestions, and next quarter you can improve upon them. That will be helpful.
Sure. Comment is noted. And as a company, we endeavor to, we are obligated to provide the results in a certain format, which we have provided. And I agree to your point that the presentation will provide all these clarifications. So we would take your feedback on that. Thank you so much.
Yeah. Okay. Thank you and all the best.
Thank you. We have the next question on the line of Rishabh Shah from Anubhuti Advisors. Please go ahead.
Thank you for the opportunity. So I think till the last presentation, we were giving a slide with respect to our management aspiration for 2026. So basically just wanted to check the revenue and EBITDA guidance which you are giving. That is purely on an organic basis. And with this couple of new acquisitions that we have been doing in Germany and Turkey, will these numbers increase from here on, or basically if you can just guidance on the volume guidance you are making in this whole guidance?
Yes. So the 2026 guidance that we will be providing remains consistent and constant. So the same slide you would see in this investor presentation as well. And that takes into account only the organic growth initiatives and some of these bolt-on acquisitions which are very small, which are not meaningful. It does not include any large acquisitions. So they could be like, $1 million, couple of $1 million here or there which could be added. But largely, this is based on the organic business growth aspirations.
Okay. And the volume growth that we are baking in these revenue estimates, both in LCL, SCL, if you can give just a rough approximate number?
So I would not be able to comment since the guidance is not being shared, but I can say that we are, and this is something which has been restating, that we have baked in the macroeconomic growth sectors based on various research reports from different consulting companies and economic research organizations, and we have factored in that we'll be able to continue to expand the market share year on year. And we've been able to do that for the last several years, and we believe that we will continue to be able to do that. And we have baked in those assumptions that there's a underlying market growth, and on top of that, there's a market share expansion, which is what is leading us to those numbers. And as you will see, and this quarter makes it very clear that the revenue comes down because the freight rates normalize, and therefore you would also notice that in the 2026 guidance also, revenue growth was subdued because these ocean freight rates normalization was quite anticipated.
Okay. Perfect, great. And in terms of your debt levels, at the 31st December consolidated net debt number does it include the payment made for the German and Turkey acquisition?
Yes.
Okay. And just last one bookkeeping question. So other expenses, consolidated other expenses for the quarter were up roughly 15%. I think in the earlier part of the call, you said that there was some one-time license cost of roughly 8 to 9 crores. So I believe this would go away from the next quarter. So can we assume 180 crores more of
that, but we do keep investing in new resources, etc. And but more or less it will be in line of that. Yeah.
Okay, perfect. Thank you so much for the opportunity.
All right, thank you.
Thank you. That was the last question. I would now like to hand it over to the management for closing comments.
Thank you all for joining the call, and I hope we've been able to provide more clarity. And given the uniqueness of this quarter, we would endeavor to take your comments, questions, and suggestions as we upload the investor presentation, providing more clarity on all the numbers. Thank you very much for joining in. Thanks.
Thank you.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.